safety. That is what's going on. Here's market watcher Jeff Sica. All right, Jeff, here is the question. Everybody's asking this. I hear it all the time. Is this a repeat of 2008?
I think there's a lot of similarities. I think there's things about this market that concern me even more than 2008, primarily because this is a market that's been built on this sense of desperation that the Fed was able to satisfy by all these different desperate measures, lowering rates, negative interest rates, all these printing, everything they've been able to do. But the problem is we have a vulnerability in banking, especially in Europe and China, that is, to me, onerous on this market.
Okay, so bank stocks, banks right at the very center of this latest turmoil. And that is just like 2007.
Right, exactly.
Bank stocks are going way, way down. Explain the relationship here. Why are bank stocks down so much? I've got European banks that are down 10, 15% today.
Right. Here's the problem. The banks have been lulled into a false sense of security, just like investors. The banks believe that their central banks in Europe and Asia and the U.S., that their central banks would bail them out. We initiated too big to fail. We bailed out the banks when they got in trouble. Now, you'd think they would have learned from 2008. Unfortunately, they have not learned. Banks are joined at the hip. There is a dependency in this global banking system where if one bank suffers, many banks suffer. That's what we have to contend with.
Are we starting with Deutsche Bank?
Yes.
And I know that they've got really serious trouble.
Concerns about the quality of their balance sheet and the fact that the guarantee for those loans, I don't want to get wonky, they're called COCOs, contingent convertible bonds. Basically, the guarantee that the government was backing up these banks isn't there anymore. That is creating instability.
Okay, banks at the center of the problem. And you say there are similarities to 2007, 2008. So therefore you believe that the stock market is headed way south, do you?
I do, and I've believed it for a while. I mean, I've been knee deep in these balance sheets in these European banks. These European banks are in trouble, and the U.S. banks have attached themselves to them. And I think what we're going to see in the market, this market has been a market that has been 100% dependent on the Fed. So when we got bad news, the market always took it as good news because the Fed would initiate this desperate measure that ultimately would create a scenario where stock prices have went up. Now investors have absolutely nothing to look forward to from the Fed except reality. Now, bad news is in fact bad news.
And they've got nothing to look forward to on the political scene in America. There's nobody going for growth. No, the Democrats are not going for growth. They're going for more taxes and more spending.
Exactly.
So there's no relief for the investor from the Federal Reserve or from the politicians, now political leadership. That's it. All right, I'm running out of time. How far down are we going?
I believe the Dow is going to be in around 14.2. I think we're going to go down pretty heavily. And here's the one thing that I will not discount, and I have in the past. I won't this time. I will not discount the Fed doing something truly desperate and truly stupid to try to stop the market from declining.
Like what?
Out Q. Don't tell us.
God knows.
Because you don't
only knows.
All right. Jeff, thank you very much indeed. You've been right before. I hope you're wrong this time, okay? But you've been right before. Hillary Kramer.